Hello traders and welcome to this video analysis explaining exchange rates, changes in pip and exchange rate unit sizes and percentage moves, and why this is so important for you guys to understand before you get into trading, because we always must best assess volatility on a percentage basis and lock how much the currency pair moves in points or pips. And this will make more sense as I go through in this video and explain this in more detail. But I'm going to start off by explaining exchange rates, and then we move on to the key topics, breaking this down throughout the video. So starting off with exchange rates, traders. So simply put, an exchange rate has a base currency and a quote currency. So looking at the Euro USD, we have an exchange rate price of 114. And what this basically means is that the currency on the left buys $1.14 in exchange when you're selling euros and you're buying US dollars. So the exchange rate is showing you the value of the euro, which is the base currency on the left, and the currency on the right is quoting the value of the base currency, and the exchange rate is giving us this quote. So, simply put, the base currency buys $1.14 in the quote currency. Looking at the dollar against the Japanese yen, we have an exchange rate price of 119 yen spot 20, and this is telling us that the US dollar, so each dollar buys 119 yen the spot 20 in exchange. So the currency on the right, as I said, is quoting the value of the currency on the left, so the base currency. Therefore, when a currency pair's exchange rate price changes, we are looking at whether the base currency is appreciating or depreciating in value. So for an example, we have the euro buying $1.14 in exchange. If this exchange rate will up to 115, then we know that the euro is now buying more dollars in exchange, so the euro's value has gone up, so the base currency has appreciated in value in exchange rate. Or for an example, it went from 114 to 113. Now the euro buys less dollars in exchange, so the base currency's value has gone down in quote currency terms. So that's pretty easy for us to understand. Now moving on to changes in price, and this is looked at in pips, and it also is really rounded off to decimal points. So all currency pairs exchange rate prices are quoted in unit sizes to the fourth decimal point, and that is except Japanese yen and Indian rupee. So looking at the euro US exchange rate of 114, we can see that the exchange rate is rounded off to 4 decimal points. And when we're looking at the US dollar Japanese yen, we can see the exchange rate is rounded off to 2 decimal points. And the last decimal point in an exchange rate is known as a pip, or you can call it a percentage, a decimal point, but some people call it pips. So now we're going to look at an exchange rate's unit size and why this is linked to a currency pair being rounded off to 4 decimal points or 2 decimal points. So in everyday life, the Euro-USD exchange rate price of 114 simply means, I'll explain, that 1 euro buys $1.14 in exchange. And we have, as I just showed you above, the currency pair quoted to the 4th decimal point. So remember, in everyday life, we deal with dollars and pence. So dollars and cents, pounds and cents. So in order for the value of the euro to appreciate for 114, the last decimal point would either increase above 0 or decrease below 0 by 100 decimal points. Or remember, we can call it 100 pips for there to be a change in the exchange rate value. So for example, we're trading at 114.00. If the exchange rate goes up by 1 pip or point, 2 points, 3 pips or points, then go to 9, 10 points. Remember, the everyday exchange rate of dollars and cents, pounds or pence, for example, hasn't changed. It's gone up 10 points, but we're still trading at 114. But if it goes up to 20 points, 30 points, 50 points, 60 points, 80 points, 90 points, once it gets to 99 points, once we get to 100 points, then we have a change in the value of the Euro USD exchange rate. So once the currency pair goes up by 100 points, we're going to move in the euro appreciating to 115. So we can clearly see that 100 decimal points or 100 units of the base currency is equal to 1 cent in the Euro USD exchange rate. Because remember, the amount of units or the amount of points, but the euros going up is quoted in dollar terms. So that's really easy for us to understand. Or for an example, if the exchange rate goes from 114 to 113.99 and it goes down to 90, so it's gone down 10 points, 80, 20 points goes down to 50, that's 50 points. 20 is going down to 80, that's going down 80 points from 114. And if it went to 0, then clearly we've seen the exchange rate go down now by 100 points. And this is her impact on the value of the Euro USD exchange rate. So from 114, we can clearly see, traders, that 100 points, once it gets to 99 and it goes to 100, then we can clearly see that 100 points is equal to a 1 cent change in the exchange rate. Or you could clearly say that when the euro goes up by 100 units or goes down by 100 units, then this is equal to a 1 cent change in the exchange rate. So from these calculations, we can clearly understand, traders, that 100 units of the base currency buys 1 cent in exchange. Now, if we understand that 100 pips or points, decimal points, or 100 units of the base currency buys 1 cent in the quote currency, then we can clearly understand that if the exchange rate was to change by 1,000 points or pips, then this would be equal to a 10 cent change in the exchange rate. So as I showed you, it went up by 100 points, went up to 99, and then we went to 100, and then went up by 1 cent. Then if we went up again by 100 points, we got to 16, 17, 300, 400, 500, 600, 700 points. Sorry, 700 points, 800 points, 900 points, and 1,000 points. So clearly, 1,000 decimal points is equal to 10 cents, or 1,000 units of the base currency exchange into dollars. So if the euro's value goes up by 100 units, or you can call it decimal points, pips, then that's equal to 10 cents. From that understanding, we can clearly see that 10,000 units of the base currency buys $1 in exchange, or 100,000 units of the base currency buys $10 in exchange. So we continue to see that understanding, traders, is quite easy to understand. So each and every time the exchange rate changes by a pip or a decimal point, one is really doing is trying to get to a point where we get some 99, and then 100 points is equal to 115. 1,000 points is equal to a 10 cent change, so it'll go from 114 to 124, for an example. And if we had a 10,000 point move, this would then change the exchange rate, for an example, from 114 to 214, for an example. So we understand, traders, how many units of the base currency the exchange rate changes by for our 1 cent change in exchange rate. If the currency pair changes by 1,000 units or 1,000 points, then this makes the exchange rate change by 10 cents. If we get 10,000 units of the base currency appreciating or depreciating, then this is equal to a $1 changes in exchange rate. Or if the base currency exchange rate changes by 100,000 units in the base currency, then this is equal to a $10 change in the exchange rate. So, easy way to look at this and understand, if we just started off at 0, 0, 0, and then we had a 100-point move, we would then get to 01, go back to 0, 200-point move, for an example. And then we got to a 1,000-point move, we'd be at 10, 0, 0. And if we got to 2,000 points or 2,000 units change in exchange rate, we got to 20. Remember, if you're looking at dollars and cents, this is basically €1 buys 20 cents. So we can clearly see, traders, that once we get to, so that's 2,000 points, 3,000 points, 4,000 points, 5,000 points, 6,000, 7,000, 8,000, 9,000, and then once we get to 10,000 units, then we know this now changes the exchange rate to $1. So you can clearly see that how many units of the base currency the exchange rate has to change by for our quote currency terms change in the value of the Euro USD exchange rate. So it's pretty easy to understand, not complicated at all. So we do clearly see for us understanding how many units of the base currency it takes to buy a cent of dollars, how many units of the base currency it takes to buy 10 cents in the dollar, how many units of the base currency it takes to buy $1, and how many units of the base currency it takes in exchange to buy $10, for an example. So we can appreciate and understand that if an exchange rate changes by a certain amount of units, pips, or points, the value that is equal to in quote currency terms, because remember, the Euro USD exchange rate is quoting you the value of the euro. So 100,000 units is quoted to being able to buy $10, for an example, right? And the exchange rate is telling you how many units is being exchanged in order to buy the current exchange rate, which we're going to move on to just now. So looking at the Euro USD exchange rate of 114, from our calculations above, we can clearly see that $1.14 is equal to 11,400 units of the base currency. So remember, if 10,000 units buys $1 and the exchange rate is $1.14, then clearly we have 10,000 units buying $1, and then we have 1,000 units buying 10 cents, so $1.10. And remember, we're at 114, so of course, and then we get to 4, this is 400 units. So we get to 11,400 units of the base currency is what it takes at the moment for the current exchange rate price to be 114 when you're looking at Euro USD. So that's really easy for us to understand. If we're looking at the US dollar against the Norwegian krona, which is a complete different exchange rate, but the same principle applies. If the exchange rate is 8.50, if we're rounding up to 2 decimal points, as you would do in everyday life, then we can clearly see from my calculations above that it would take 85,000 units of the base currency in order to buy 8 kronas than 50 in exchange. Because remember, if we are looking at 10,000 units in the base currency, so 10,000 units of dollars buys 1 krona in exchange, and exchange rate is 8.50, so 8 krona and 50 in exchange, then clearly to get to $8, you have to have 10,000 units times 8, so that's 80,000 units, and then to have the exchange rate of 5, then clearly this is equal to, and that's so sorry, to have an exchange rate of 50, so 8.50, then clearly 1,000 times 5, and we get to 85,000 units of the base currency is being sold and exchanged to buy 8 kronas and 50. So that's quite easy to understand, traders. So always just use this table here to really understand that if you have an exchange rate of 8.50, clearly we understand that if 10,000 units is buying $1 when you're looking at Euro USD, but the principle still applies when you're looking at USD Norwegian krona. 100,000 units of the base, 10,000 units of the base currency buys 1 krona in exchange. So if the exchange rate is 8.50, when we round off to 2 decimal points, and clearly we have 85,000 units of the base currency buying 8 kronas and 50 in exchange. So if you ever want to work out how many units of the base currency it takes to buy the current exchange rate, all you simply have to do is write out the exchange rate in a calculator, and it will make this exchange rate so easy for you to see how many units are being exchanged. But don't put any decimal points in, just put that actual number, and it will work out the amount of units or the base currency being exchanged. That's the easiest way to do it. So, calculating pip movements. Now, this is really important to understand because a lot of traders do make the mistake of trying to compare currency pair moves by looking at pips. And this is a big mistake you'll make, because if you're not looking at percentage moves, you can end up losing money, because the volatility of an exchange rate may cause you to have your stop loss hit on multiple occasions, because you're trying to compare opportunities in pit values or pit moves or points, instead of actually looking at percentage moves. Now, I want to go into this in a bit more detail, and just to really open your mind to understanding how to assess opportunity and risk in the market. So when to collect changes in exchange rate prices between two currency pairs, we cannot compare the price change by looking at the amount of decimal points or pips each currency pair's the exchange rate price has changed by. Opportunity and risk can only be assessed through comparing percentage terms and not decimal points and pips. Now let me give you an example. The Euro-USD exchange rate moves 200 decimal points from 114 down to 112, and the USD Norwegian krone exchange rate moves down 200 decimal points from 8.50 to 8.48. Both currency pairs move 200 points, but the moves are clearly not the same. Euro-USD on the right-hand side moves from 114 to 112. We can clearly see here goes on 200 points, and this is equal to 1.75% move in the exchange rate. The Norwegian krone goes down by 200 points. This is equal to 0.24% in the exchange rate. So why are they so different? Now we're comparing currency pair moves in points as a percentage. We must remember the points that are moving in exchange rate. So 200 points movement in the Euro-USD exchange rate and 200 points movement in the USD Norwegian krone exchange rate is going to be different because of the unit sizes it takes for the current exchange rate price. So we saw that a 200 point move is equal to 1.75% for Euro-USD. We had a look at the USD Norwegian krone exchange rate going down 200 points, and it's only equal to 0.23%. So why is this? So we already calculated that for the Euro-USD exchange rate to be trading at 114, it is equal to 11,400 units. Therefore, 200 points as a percentage of the total amount of units being traded in this exchange rate is equal to 1.75%. So 200 points movement is equal to 1.75% in exchange rate. So this is a typo mistake, my apologies. Because if the exchange rate Euro-USD is 11,400 units of the base currency, it takes in exchange to buy $1.14. 200 points is only 1.75% of 11,400 units. Okay, so we understand why this is 1.75%. But look at the Norwegian krone. Remember, it's 85,000 units of the base currency it takes to buy 8 kroner and 50 in exchange. So 200 as a percentage of 85,000 is only 0.23%. Now, why is this so important? Is because we must always remember, traders, that currency pairs volatility is so important to assess when we're getting into the market. This is why I'm trying to explain why it's so important to match up pip moves in percentage terms and not pips. So for an example, the USD Norwegian kroner's exchange rate may fluctuate on average by a certain amount on a daily basis, a weekly basis, or a monthly basis. So if you're a trader in the market, you're an intraday trader, you need to understand on average how much does this currency pair move in the markets. Because if I'm putting on a position, I need to know how far to put my stop loss, but I give the market enough room for it to move as it usually does without me getting stopped out in the trade. And If I'm trading on a weekly basis, then I need to know on a weekly basis, on average, how much does this exchange rate price move by. So when I'm placing my stop loss, I make sure I give the currency pair enough room to fluctuate in price without hitting my stop loss, because I haven't given the market the breathing space that it historically needs over a 1 week window. And it could be said for saying for a 1 month volatility assessment, we need to look at how much does it chase by on a 1 month basis to know where to put my stop loss. But as if your stop loss is too tight, because you're looking at it in points but not percentage terms, you're going to continue to get stopped out of the trade, and you're not going to understand why. And it's because you've not given the quotes bit enough room to maneuver, and each currency pair's volatility is completely different. Okay, so I'll explain this in a bit more detail. So now when calculating how many decimal points the Euro USD, or pips, for example, the Euro USD and the Norwegian krone will have to move in order to match each other in percentage terms, the moves are drastically different. So for Euro USD to move 1.75%, we saw the exchange rate has to move 200 pips or decimal points, and we could see that clearly here. 200 decimal points, and the exchange rate moved by 1.75%. However, when looking at the Norwegian kroner to move 1.75%, a currency that has to move 1,487 points. So that's a vastly different amount of points. You can clearly work out the points by looking at taking the exchange rate of where you're coming out of the market compared to where you got into the market, divided by the entry price times 100 gives you the move in the exchange rate. So traders, why is there such a vast difference between Euro USD and the USD Norwegian kroner? Well, again, traders, it just comes down to the amount of units being traded. So if I want to see the Norwegian kroner move 1.75%, and I want to see the Euro USD move 1.575%, remember, these moves are going to be so different because of the unit sizes that we are trading in the exchange rate. So remember, USD Norwegian kroner trading at 8.50 is equal to 85,000 units. So we need to know what is 1.75% of 85,000, and it's 1,487. So for the market to move 1,487 points, that's equal to a 1.75% move in the USD Norwegian kroner. Could remember, for the US dollar to buy 8 kroners and 50 is equal, as we looked at earlier, to 85,000 units. So if we go back over to the chart, we can clearly see that when we look at USD Norwegian kroner, 1,490, we're very close to our number, is what it takes in pips to reach 1.75% compared to only 200 points. We're looking at Euro USD. So clearly the moves are vastly different because, again, as it explained, 200 points of Euro USD movement is equal to 1.75% of 11,400 units of the base currency being exchanged into dollars for this exchange rate. But because we're looking at the USD Norwegian kroner exchange rate of 85,000 units, 1.75% of 85,000 units is 1,487 pips points. So vastly different when they're looking at two exchange rates. So this is important, traders, to understand. We have to assess opportunity and risk in terms of looking at percentage moves. I never tried to compare an exchange rate by looking at points move, because the unit size it takes for an exchange rate is completely different because no exchange rate is the same. So when you have $1.14 in exchange rate for Euro USD, we worked out that it takes 11,400 units of the base currency to buy $1.14 in exchange, and for the USD Norwegian kroner, it takes 85,000 units of the base currency to buy 8 kroners and 50 in exchange. So if we're looking at points, we can clearly see 200 points as a percentage of 85,000 units is going to be a much lower percentage move compared to 200 points out of our 11,400 units of the base currency. So clearly we can see when looking at exchange rate prices, why some currency pairs in pip terms moves a lot more in than, for an example, Euro USD. So for an example, on a daily basis, you could see here that the USD Norwegian kroner in one day, the exchange rate moved by 784 points. But looking at Euro USD, on a similar move, the exchange rate is only moving by 60 points, okay? But because clearly the unit size we're trading is vastly different. So, as you all see in the other video, when we're trading the markets, remember our profit and loss is calculated for each pip, but the currency pair moves. So if a currency pair moves by 700 points in a day, and you're trading £1 a point, you could be losing £700 in a day if you do not understand how why a currency pair moves so much in on the exchange rate, compared to when currency pairs like the Euro USD in pips doesn't move anything as much as the USD and Norwegian kroner. So traders, we understand why this is the case. Allow me to take you on to looking at some Japanese yen and Indian rupee pairs and unit sizes, because this is important for you to understand, because if you're currency trader, you're definitely going to be trading the Japanese yen at one point, because the yen is one of the major currencies in the markets. So the Japanese yen and Indian rupee are quoted to 2 decimal points in exchange rate. So as we look here, we can see the US dollar Japanese yen exchange rate of 120. So 120 yen in exchange for $1. So when, as I said, base currency is being exchanged into the quote currency, and the exchange rate price is quoting how much of the quote currency you get in exchange for each unit of the base currency. So $1 buys 120 yen in exchange if the exchange rate was 120. So each unit of the base currency, when you're rounding off to 2 decimal points, is equal to the value of 1 cent in the yen. But obviously, in Japan, they don't use dollars and cents, pounds and pence. They have their own calculations, but it's exactly the same. So clearly, we can see that a 1 pip change in exchange rate is equal. So 1 unit of the base currency is equal to 1 cent, or from example in the Japanese yen. So if the exchange rate moves by 1 point, 2 points, 3 points, 10 points, then we get a 10 cent change or 10 yen change in the exchange rate. If it goes up, so from 120, if it goes up to 99 pips, and then we go to 100 pips, then we go to 121.00 for an example. So clearly we can see that 100 units in the base currency is equal to 1 Japanese yen. So remember what I said, we're at 121. We go up to 90 points, 99 points. When we get to 100 points, we see the exchange rate go up to 122. And then we go back to 0. So clearly 100 points is equal to 1 Japanese yen. 1,000 points would then be equal to 10 Japanese yen. So for an example, that was 100 points. You went up by, so if we went up by 100 points, 200 points, 300 points, 400 points, 5, 6, 7, 8, 9. And then when we get to 10, then we know we're going to have a change in the exchange rate up to 130. So 1,000 units or points in exchange rate is equal to a 10 yen. So 100 units of the base currency buys 10 yen in exchange. 100 units of the base currency, or 100 decimal points of pip move, is equal to 1 Japanese yen. 10,000 units of the base currency, or 10,000 points, pips, is equal to 100 Japanese yen. Whoops, so with a typo. We can clearly see that 100,000 units of the base currency is equal to 1,000 Japanese yen. So clearly shows we can understand that dynamic. So when exchange rate is 120, then clearly this is equal to 12,000 units of the base currency is being sold in exchange to buy 120 Japanese yen. Because remember, if 10,000 units is equal to 100 yen and the exchange rate is 120, then clearly we have 10,000 units buying 100, and then we have 2,000 units, buying you 20, and we get the exchange rate of 120. So if the value of the US dollar changes by 200 units or decimal points from 120 to 118, this should be equal to a 1.16% move in the USD JPY exchange rate. And again, all you have to do is do 200 divided by the amount of units times 100, and you get the percentage move in the exchange rate. So that's easy for us to understand, traders. It's exactly the same when you're looking at dollars and cents, pounds and pence. So if the exchange rate goes up by 99 points and it goes up by 100, then we'll go to 131. So we clearly see that 100 units of the base currency buys 1 Japanese yen in exchange. So if the value of the dollar goes up by 100 units, it buys an extra 1 yen in exchange. If the dollar goes down by 100 units, then it's gonna lose its value and go down to 130. So 100 units of the base currency is equal to a 1 yen change in exchange rate. 1,000 units of the base currency is equal to a 10 yen exchange. You can buy 10 yen in exchange, or 10,000 is the base currency buys 100 yen. 1,000 units buys 1,000 yen, so on and so forth. So once we look at an exchange rate, we can clearly just understand that the exchange rate is 120 is equal to 12,000 units. From our example we looked at previously, if the exchange rate moves by 200 points, it is equal to 1.16% in the exchange rate. So why this is important for us to understand, traders, is because if we're looking at the USD JPY exchange rate, so let's take it over here. Let's say, for an example, that the average, if you're trading on a 1 month basis, and say, for an example, you have a risk to reward of 3-1. So if you're risking 2% of your account, you're trying to make a 6% return on your profit. And the exchange rate, you worked out that on average, the exchange rate moves by, say, 4% per month. And you need to make sure that you put your stop loss at a certain amount of points that's equal to 4%. Then you know that your stop loss is going to have to be around 440 points. And that's because, sorry, but this is a different exchange rate price at the moment. So if we're looking at 120 in exchange rate, we need to understand what is 4% of a current exchange rate. If it was at 120, and it's easy to understand, traders, all we have to do is just take out a calculator and have a look. I would do 4 divided by 100 times 12,000 units. Right. Like, if I'm being wrong. My apologies. So if you want to work out how much 4.4% is, how much 4% is of, my apologies, I did it wrong. I'm going to take you back over here again. So if we're looking at 4 divided by 100, 4 divided by 100 times 12,000 units. 12,000 units is equal to 480 pips, or points is how far our stop loss would need to be for our volatility, in terms of where to place a stop loss in the market. So whenever you're looking at volatility and you want to know where to place your stop loss, traders, it's really easy. You just do a simple calculation where you do, for an example, if you look at volatility stop loss and it's 4%, usually 4 divided by 100 times how many units we're trading in exchange rate, and then you're going to know how many points you need to put your stop loss in order to get a 4% breathing room, or what space for the currency market to trade over a 1 month window without hitting your stop loss. So working out an exchange rate unit size, again, as I said, the easiest way to understand what the exchange rate is in terms of units is to clearly just write it out in a calculator, and that will make it much easier for you to understand. So for an example, if exchange rate is 132.18, all you have to do is write this out in a calculator, and this be equal to 13,000 units, 218 in exchange. And if we're looking at Euro USD, then we just write this out in a calculator, and this is equal to $1.10 in exchange. So traders, I hope that makes sense. Thank you for watching. This is my video analysis looking at exchange rates, pips, unit sizes as the percentage moves. Thank you for watching.